Welcome to my channel. I'm Dr. Romano. Recently, I've heard that Credit Suisse is going bankrupt or filing bankruptcy. Recently, I've heard that the investment bank Credit Suisse is having some financial issues. Now, you'll hear in the media that the bank said that there's a lot of mismanagement over 20 years, and they're making up all these excuses as to why they're going under. Of course, I'm sure the Swiss government will bail them out and not let that systemic risk affect the country and the banking system. But you have another example, just like in 08 and 09, as to why these big banks go out of business. When you have 5 levels of management, this type of management is very bad for companies. Because you have 5 levels, it takes so long for change to happen that when you work for a big bank, you're just giving your opinion as to what needs to change. And so as a director, let's say, how long does it take to make these changes happen? And you have to also remember, when people work for companies, they don't want to create too much havoc, and they don't want to take too much responsibility for something going wrong. So they just follow what everyone else is doing, and this is why you have this systemic risk that's happening. You cannot have trading groups so large and have employees trading the company's capital. You're seeing this now with large hedge funds. They have many traders trading their capital because they have so many billions under assets under management that their returns get watered down. Well, at the investment bank, this is also have been happening. That's how they make money, based on trading capital and hiring traders. But you have to remember, when an employee is an employee of a company, they are going to hold back with taking responsibility, because they're afraid of losing their job. They're afraid of dealing with the dominant person in the group trying to get rid of them. They're afraid of many reasons. And this is why smaller hedge funds do so much better than investment banks and large hedge funds, because that person took the responsibility into their own hands. They were able to tweak their trading strategy to make it better, and they were able to tweak their risk approach to make it more safer and to make better profits. Because there's one level of management at a hedge fund, at a small hedge fund, that hedge fund is going to flourish to do so much better and to be so successful, to make those returns. Not a 10% return, not a 15% return. I'm talking about 30, 40, 50% in a year that doesn't make any sense. And so those hedge fund managers out there that are capable of taking the responsibility into their own hands, not only are they willing to tweak their risk approach, but they're also willing to increase their knowledge on how to raise capital, how to manage a company. Everything about finance, they're willing to dive into it and to make it better, because they realize that if they don't perform, they're not going to be in business. But the investment bank trader, please remember, before we continue the video, to do thumbs up right there to say thank you, Anthony. Thank you so much. A trader at the large hedge fund is not thinking like that. They're just an employee. They just want to do the mediocre. They can't tweak their strategy. They can't come up with a new risk management approach. They can't do any of that. This is just another reason why the Credit Suisse is going bankrupt, because you have so many levels of management, no one really taking control of what's really happening. The employee is just waiting for the next person to take over the position, since most people last 2.5 years in that position, and that's according to the book of occupational titles. Yes, there are people that last longer to work for the company, but when you're working in a group that's just managing situations, doing the day-to-day responsibility, in other words, the 1% of what that company does, they're just waiting for the next person to take over. And I'll tell you a really good example. When I worked for the investment bank in Manhattan, I I didn't know what the job was because my friend, he didn't want to tell me anything. He just gave it to me. That's how you get these type of jobs through your friend. And it was working in the chief financial office for risk management. And when he got hired, he hired his friends because that's how you do it. He wanted people that he could trust. And he put me in a position called a risk analyst. My job was to review the trading books before the chief financial officer would review them. And my job was to make sure the data was accurate, submitted, the areas that were overexposed, were they being investigated by the risk managers, etc. And I had to put bullet points on that page to make sure that the chief financial officer knew what was going on. Now, in that position, he trusted me for that job because what happens is when you're dealing with the head traders of each group, they are more likely to bring you out on Thursday night for drinks, and they want to give you the impression that they're going to give you an assistant trader's job, and they're going to protect you, and they're going to give you all these jobs and benefits. But the fact is, they were just smoozing me to let them get away with what they were getting away with. They would submit their data whenever they would feel like it. They would submit their losses, and instead of showing a $10 million loss, they would put it over 5 days. So the area would not be overexposed. That's illegal. And at that time, that actually happens because of the investment banks in the 80s and 90s. They merged together to create the big, large companies that they were, because they didn't merge their risk management software and their programs and their systems together to become one large company. They had multiple risk reporting systems reporting to all different types of mainframe computers, etc. Some of them were very old, some of them were new. And so it took until my friend was hired to realize that the data quality of the company was really bad. And the actual losses that the chief financial officer were looking at, they were not accurate. And so he hired 20 consultants to create a new system. And so what did he do by doing that? He took the control into his own hands, and he improved what the company needed. But you see, not everyone's going to do that at a big company. But because he worked for himself, because his father was a billionaire, he knew what it was like to work for the family. And so he took that quality and he brought it to the big company, and he improved the data quality of that company. But you see, at investment banks today, are they really improving the quality of the company, these employees? And the question is, and the answer is no, they're not. And the reason is because there's 5 levels of management, and it's too much management for that type of company. If you want to have people trade your capital or invest your capital, however you want to see it, you need to go with small companies. And this is just another reason why the funds of funds industry is booming now, because it's a small company. You're dealing with the owner of the company. The owner of the company is going to make sure that everything is perfect and done perfectly right, and is going to make sure that they maximize their returns with least amount of risk. This is all very important because the investment banks, they're so large, they cannot manage capital like a smaller company can. Because there's so much management lost and wasted in those big companies, and things fall under the sofa, so to speak. But at the funds of funds level, at a small company, the manager is able to produce quality management. And this is why the hedge funds for the past 20 years have grown and grown and grown like they have. Because large investors realize that it's not worth it anymore to go invest your money into an investment bank because the returns are puny, number one. And number two, they could go bankrupt. And 3, it's better to invest in a smaller company, have multiple companies trading your capital, Even if you're a trillionaire or a billionaire, if you're a billionaire, you would want multiple companies trade your capital instead of 5 investment banks trading your capital. Secondly, for the SEC to listen to this, it's much better to have thousands and thousands of traders, traders that are hedge fund managers, to trade investments capital instead of having 5 or 6 investment banks trade the capital. Because what happens is when there is a turn down in the market, you're going to see like the late 1980s, just one day just dropped. Or like 08 and 09 just dropped. Or like to this year was a different type of drop. Because you have so many more people taking the control into their own hands and trading capital, opening up hedge funds. We've seen, instead of having 1 or 2 days in this year drop so much, it's been dropping since January of 2020. And it looks like a perfect train wreck going down the mountain, instead of having 1 day to lose all that wealth. And this is why this time around, investors, because there's so many more hedge funds now, they're able to reanalyze situations so much faster, and because they're able to change so much faster, because they own the company, they're able to manage their losses. And this is why, for example, the losses at hedge funds these days aren't so bad compared to the investment banks. It's disgraceful. And this is my edge on why that is and why investment banks are a terrible investment. Thank you so much for watching. I really appreciate it. I also want to mention that because of the US government passing laws that stated that the Swiss government had to notify the American government that any Americans have capital in their country. So what did the Swiss government do? They threw out the American accounts. This also played a role in the dwindling of the wealth of the bank, because the bank wasn't so big anymore. Now, today, you have the Russians pulling out of the banks around the world because they're afraid of their capital getting taken away. Now, what you're going to see is China and Korea doing the exact same thing. They're going to be pulling out of their banks around the world because they're afraid once they invade Taiwan that the world is going to do that to them. And so that's a big reason as to why Credit Suisse is dwindling down. And you're going to see that amongst many investment banks in the next couple of years, etc. A lot of money is going to change where it's being invested. And so we probably will experience that in America soon, as well as the real estate market falling down. And so if people aren't paying their mortgages, well, that affects the investment bank. But you have to remember, this time around, there's a lot more corporations owning real estate in America that are prepared to have a turn down in the market. So I don't see the losses so bad in America with the mortgage defaults. However, I do believe that we have less competition in the real estate market because Russia and China are not going to be buying real estate, that the price will drop 30 to 50%. Ray Dalio is saying 50%, I say 30%. But it depends where, because certain places like resort villages could receive a 50-60% drop, right? Because that's high-end real estate, that's second house. And if you don't have money or you want to pull back on spending money, you get rid of your vacation properties. And so that's just a reason why the markets can drop so much. Thank you so much for watching. I really appreciate it. And please remember, if you want to subscribe to my channel, just press the button and do thumbs up to say thank you. It's right there to say thank you to me and let me know that you appreciate my video. Thank you so much for watching. I really appreciate it.